I think in March, we did see the overall number decelerate. When I went back and looked at 2025, I'm like, is this a normal thing for March or is it an unusual March? Last year, we saw the same thing.
All right, joining me will be Troy Cates, co-founder and managing partner of NEOS Investments, who has quietly become one of the fastest growing ETF issuers out there. This is a firm who launched its first ETF in August of 2022. And in less than 4 years, they've already grown to over $22 billion in assets, $22 billion across 19 ETFs. And I would say they've really hung their hat on options-based income strategies, which of course, that's been an excellent spot to be in ETF land. But NEOS has definitely capitalized on that. And so Troy and I are going to discuss that growth and some of the big drivers here. And then we'll do a little tour through their ETF lineup. I've picked out several ETFs that I want to get his take on, including the NEOS Bitcoin High Income ETF, ticker BTCI, which I know that won't surprise anyone. And then the NEOS Gold High Income ETF, ticker IAUI, which that actually just won an award for Best New Options Income ETF. So we'll look at those, and we'll also get into due diligence and education around options-based ETFs overall. Now, to start this week, I'll be joined by Cinthia Murphy, investment strategist at VettaFi. And as we like to do from time to time, we're going to look at the latest ETF flow data, which it's perfect timing, given that we just wrapped up the first quarter of 2026. And as always, there's some interesting stories to be found in that data. So we'll tell you about those, and we'll also spend a few minutes looking ahead to the remainder of the year. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let's start this week with VettaFi's Cinthia Murphy. Cinthia, great seeing you again.
Hey, Nate, always a pleasure.
Have you fully recovered from exchange a couple of weeks ago?
Do we ever fully recover, especially at my age? What I love about the event is the momentum just keeps us going. I find it very energizing. It's tiring, but it's very energizing. So it was a great event this year.
Well, it's good to have you back on here after we recorded live in Vegas. So as I just mentioned, end of quarter, or I guess it's the beginning of the quarter now. That's always a good time to take a look at ETF flows. And I thought to set the backdrop here, if you don't mind, I want to first provide some performance figures from the first quarter. I think those will help add some context to our conversation. And so if you look, the S&P 500 was down over 4% in the first quarter. The NASDAQ 100 was down 6%. Broad developed international stocks, those were up about 1%. Aggregate bonds were essentially flat, and gold was up 9%. And I wanted to provide those figures because if you look at ETF inflows, guess what? It was a record first quarter. So even though the performance wasn't great, that did not slow down ETF investors at all. And so I thought, let's start there. What did you make of ETF flows overall in the first quarter?
So I'd love to say that we're surprised by the numbers, Nate, but I think we've gotten used to if we don't make records, that's the bigger story. So it was another quarter of records. Overall, total flows for the first quarter exceeded like $460 billion, which if you compare to first quarter 2025, that's about a 50% year-on-year increase for the quarter, which is a huge number. And every single time we see the market get challenging, every single time we see volatility spike, we don't see folks flocking from ETFs. We see folks going away from ETFs. We see them going to ETFs to navigate challenging markets. So I find that always reassuring. I find it exciting to see. And the first quarter delivered. I mean, there was definitely a change of tone in the first 2 months to March. There was definitely a shift in terms of what types of ETFs folks started buying as the war in Iran took place and changed the market dynamics. But a blockbuster quarter in terms of overall flows.
Yeah, and there was some deceleration in flows in March, which we can talk about that in a moment. But just top level flows, you look at January was somewhere around 170 billion in inflows, February 190 billion in inflows, and then March was over 100 billion. So again, we can talk about March in a moment. In terms of specific ETFs, if we look at the ETF inflow leaderboard from the entire first quarter, there were at least a few surprises on here that I want to ask you about. And I think this first one, this is a shocker. And that's that the Vanguard S&P 500 ETF, VU, that was not at the top of the list, which you really don't see that very often. Instead, the top flow getter was a State Street Spider Portfolio S&P 500 ETF ticker SPYM that had 26 billion in inflows. VU was number two with just over 22 billion. Now, I know sometimes there can be noise in the flow data, especially with these larger ETFs, right? There's rebalancing and tax loss harvesting and those sorts of things. But SPYM, if you look over the past several years, it's really been coming on strong, for a while now. So what did you think about that?
I think I was surprised when I saw VOO come down to second place because it's been on that top spot for what is it now, 2 years. And it was all due to big March outflows, like something like $11 billion. So to your point, Nate, I mean, model rebalances, some profit taking things happen. I mean, you don't just see VU go from taking in that kind of money every month, and then one month you see 11 billion outflows. So I wouldn't read too much into that. But the SPYM story is interesting to me because it's a fund that it's, again, S&P 500 exposures, the same as VU, but it is the cheapest in the category, the 2 basis points portfolio. And so we've seen retail take up to this fund, and we've seen just slowly amass this following. And it's a reminder that fees matter, especially in a market that's getting a little more defensive, in a market where folks are going back to traditional benchmarks for some kind of safety. Paying 2 basis points, maybe that's giving just the edge it needs in a market to compete against a VU in 2026. So, fees matter, even though we seem to be a little more immune to fees and more tolerant of higher fees. I think SPOM is telling the story that, it still matters to a lot of people.
Yeah, and I still wonder. I know this was a prediction that I had last year. I had predicted that either VU or IVV or both would chop their fees, and they didn't. And I wonder, with the momentum that SPYM continues to have in that 2 basis point price point, if at some point Vanguard or iShares comes in and does reduce their fee. So we'll see what happens there. Fun fact for you: if you look at SPYM, that's now in the $100 billion club. So it's actually over $120 billion to be exact. If you look at the entire ETF space, only 19 of the over 5,000 ETFs are in that club. So pretty good company for SPYM. Going back to the first quarter ETF leaderboard, if you look, the third top flow getter, but behind SPYM and VU, was actually an ETF I spotlighted last week on here, and that's the ProShares Genius Money Market ETF, ticker IQMM, nearly $22 billion in inflows. And it's funny, I told ProShares Simeon Hyman that I certainly was not expecting a money market ETF to be a source of industry excitement and attention, but here we are. So any comments on IQMM?
Well, the number is staggering. We did some coverage. Some of my colleagues on the team did some coverage on this fund just last week. I posted yesterday on LinkedIn. And in truth, out of this $22 billion in inflows, a fund that just launched, February? I mean, it's unheard of. A lot of this money is from ProShares itself. As you know, you've talked to the folks at ProShares. They're using now this ETF as a cash management tool within their own fund lineup. So it's not just organic cash that has been flooding into this fund. But what's unique about this money market fund is that it's built around some really strict regulatory requirements around stablecoin reserves and around the Genius Act. So it's a fund. What I think is interesting, it's a money market fund. Well, big deal. Well, it actually solves a problem. So I love about this, the fact that it's innovation that came to market that solves a very specific problem. And there you go. Demand is there. It's successful. So it's always, I always find it exciting to see a new launch that actually delivered a solution that some folks needed. And then we see success in the asset gathering story.
And you mentioned how this is being used for cash management purposes and other pro shares funds. I told Simeon, I actually thought that was genius, no pun intended, because as you know, having assets in an ETF, that attracts additional assets. And whether we like it or not, that's how it works. And so if you have, say, an advisor out there, or if you do have these stablecoin issuers looking to put money into a product and they see that it has over 20 billion in assets, they're going to feel a little bit more comfortable with that. And so I actually thought that was smart. And we should also point out too, because I know this question comes up, pro shares, when they use this for their cash management purposes and other funds, they're not charging a fee on IQMM. And that I think some people thought, well, hey, are they double dipping here? And that's not the case. So I think this was a well executed launch, and it will be interesting to see, just because with the projected growth of the stablecoin market, if you're a stablecoin issuer, to know that this meets all the requirements of the Genius Act, it's an easy button approach. And there are other places they can park, other ETFs as well, but you can be 100% confident that this meets those requirements. So I thought this was really well done by ProShares. Okay, let me quickly run down the rest of the top 10 inflows from the first quarter. So number 4, SGov, the iShares 0 to 3 month Treasury Bond ETF. Then you had VTI, the Vanguard Total Stock Market ETF, IEMG, the iShares Core MSCI Emerging Markets ETF, VXUS, Vanguard Total International Stock ETF, RSP, the Invesco S&P 500 Equal Weight ETF, VEA, the Vanguard FTSE Developed Markets ETF, and then number 10 was GOVT, the iShares US Treasury Bond ETF. So look, a lot of familiar names here that we see quite a bit, but anything in particular standing out to you before we move on and look at just March?
Yeah, I'll just quote Phil Camprell from JP Morgan Asset Management at Exchange on the panel. We're talking about where to park money, and he called 2026 the year of, quote unquote, the revenge of diversification, which I loved the concept. Diversification is finally working. I mean, you see this here on some very basic level, bonds, international equities, a little bit of the who is who of the big traditional names. But we've seen this in flows. It really is a much more diversified story this year.
I'm not taking a victory lap just yet, but guess who predicted that international ETFs would be at the top of the leaderboard? We have IEMG and VXUS. I saw that coming. We'll see if they can hold throughout the year. Okay, so that was the first quarter overall. Again, if we drill down and look at just March flows only, which I think will give us a better sense as to what's been happening here more recently, because obviously with Iran and some of the stuff going on, there has been at least a little bit of a shift. And as we noted, the flows were still very strong, but they did decelerate from January and February. And again, bear with me. If I look at performance, the S&P 500 was down about 4% in March. NASDAQ 100 was down about 4%. Developed international stocks were down 8%. Aggregate bonds were down 2%, and gold was down 10%. And again, obviously the geopolitical backdrop, I think that was the primary driver here with the Iran war. But what are some trends that jump out to you if we look at, again, just March?
So I think in March, we did see the overall number decelerate. When I went back and looked at 2025, I'm like, is this a normal thing for March, or is it an unusual March? Last year, we saw the same thing. January, February, really strong. March decelerate. So I don't know if there's, maybe there's a little bit of a seasonal thing in March that happens. This year specifically, the war, the spike in volatility just suddenly shifted where appetite went. So March was a huge month for fixed income, and not just any kind of fixed income. It was back to the cash-like safety of money market funds, ultra short bond funds, your IQMM, SGov, Bill, all of them top of the charts because folks are nervous about markets, volatility spiking. All of a sudden, there were so many questions about what happens to even rates, sticky inflation now. So now there's a chance rates may actually tick up. So guess what? All that sudden, that new appetite we had going on for some duration exposure, that evaporated. We saw outflows on long dated bond ETFs. All that money flocked back to the nearest cash as possible, which was really interesting to see. Maybe not surprising, but we saw that demand go, and fixed income took over like 45% of total flows in March. It was a huge percentage. There was really appetite for hunkering down and waiting to see what the market was going to do next. That's what stood out to me the most.
Anything on the equity side or alternatives standing out to you?
So equities, I think is interesting that we continue to see. We also talked a little bit about this. The international equities deliver. Performance has delivered. Folks continue to chase that performance. I believe there was appetite for things like your classic large cap equities, some S&P 500 funds like SPYM. There was, a lot of money going back to some traditional benchmarks. Just kind of a flight. I interpreted it as being a flight to quality and safety. Some of these giant companies, they're kind of stable earners. There's still, if you think about it, Nate, we're just starting, earnings. There's still expectation of double-digit earnings growth for the S&P 500 this year, which if it happens like in the first quarter, we're talking about 6 consecutive quarters of double-digit growth. So there's still like strong momentum within the U.S. equity market. But there's been a lot of nibbling at the edges on the international equity opportunity. And we saw in the first quarter a shift from a focus into growth U.S. stocks to value. So definitely that tilt kind of took hold in the first quarter. Again, classic defensive playbook, classic diversification playbook. So that fixed income equity dynamic was very interesting.
Yeah, on the international side, as I mentioned, if you look at performance throughout the first quarter, international stocks did outperform, but they were down much more substantially in March alone. And I know we've talked about this ad nauseum. It'll still be very interesting to see if advisors are going to stay committed and continue putting money to work in this area because I do think there has been performance chasing if we look back over the past year or so because of the outperformance there. But if we get a couple of months or 3 months strung together where international equities are substantially underperforming, that could change the tide there. The other thing I'll say to your point on fixed income, I was looking, if you look at something like SGov, that's yielding around 3.5, 3.6%. If you look at BIL, I think that's around 3.7%. And it's the whole T-bill and chill that with all the volatility we've seen in the market, if you think valuations are a little bit extended, maybe you are still a little apprehensive in allocating internationally. And then you look over on the fixed income side, to your point, with some concerns that rates could continue to tick up a little bit. There's still inflation concerns out there. What's going to happen if oil keeps rising? Does that filter through or flow through and drive inflation? So if you have all of those concerns, it does make a lot of sense that maybe you would park in shorter term treasuries. And I think that's clearly what we saw there. The only other thing I'll mention is the commodity story continues to be interesting to me. We haven't talked about that yet. I noted gold was down pretty substantially in March, and there were some outflows there. I still think gold longer term is going to continue to get a lot of interest with everything going on because that gold just does whatever it wants in a portfolio, right? You don't know what it's going to do, but that's a good thing as a diversifier. And I think that'll be attractive to a lot of investors and advisors. So I think that's an interesting story to watch. Energy sector ETFs, what we're talking commodities, those actually had record inflows in March, 5 billion. Now, I always tend to see those as a little bit more tactical trades. I think those are more difficult to try to time longer term, but I think that's an interesting story. So there's a lot that I feel like a lot of different stories are surfacing now because of what we're seeing in the markets.
Yeah, and I think it all is going to depend on what happens next. So, we have Jen Nash on our team that covers all the macroeconomic data on a daily basis. And her latest read is, consumer sentiment has come down, inflation expectations have gone up, just a general sense of people are nervous. So I think in gold, for example, I agree with you 100%. But gold had gone up so much. And I think what we're seeing is a little bit of trimming a little bit at the top there and then shifting into energy, which nobody has cared about energy for the longest time. We haven't seen anybody like energy sector, oil futures. It's been kind of like a sector that we don't really care too much because it's over 3% of the S&P 500 today. So we've seen a shift into that, but I think the real assets story is going to continue to be big this year, especially with this, against this inflation story. And then there's crypto, Nate.
You're right. We haven't talked about crypto. I'm glad you brought that up. Anything you would note as it pertains to crypto ETFs in either March or the first quarter?
Yeah, well, in crypto, I think that the one thing I noticed was it continues challenged in terms of flows, but we're starting to see trickle it back in. So I think that is gathering a little bit of momentum. It has been very challenging, but it could be that as folks grow worried about everything else, crypto finds a strong footing again. So I know that's what you're hoping for. So I'll cheer it on with you.
I'm not hoping for anything. I'm an observer of the markets and the ETF space. I'll say this. I think it's really interesting that if you look at the performance of crypto overall since early October, I've talked a little bit about this over the past several weeks, but Bitcoin being down 40, 45%. If you look at Ethereum, 50, 55%. You go to Solana, down something like 60 or 65%. But if you actually look at ETF flows into these products, not bad. There's been outflows, but really not substantial year to date, or not what you would expect with a performance. So to me, I think that's a really positive indicator moving forward that a lot of the capital that has gone into these products is longer term oriented. It's not real tactical. So I think it's going to be sticky. It's going to stay put. But I also think it shows some confidence in the market overall that maybe this is a good place to be longer term, and it can offer some benefits to a portfolio.
Yeah, I think anytime we see any asset class see a sell off, we see that easy money that came in go. But if you look at things like 13F filings, institutional money, every time it drops, we see more buying. So to your point, the sticky money is growing stronger and stronger and is buying at the dips. But it's the volatile, the performance chasing money that I think makes a lot of noise as it comes and goes. And that's what we get distracted with, maybe.
All right, a few minutes left here. If we look ahead to the remainder of the year, are there any big ETF flow stories you'll be watching, whether we're talking broader ETF categories or even more granular categories? Maybe give me a story or two that's on your radar for the remainder of the year.
Yeah, I honestly, when there's a war taking place, it's really difficult to anticipate what's going to happen because it all depends on how long this lasts. So I think the energy story to me is fascinating. Energy has been such an underdog, and I love the underdogs. So I'm going to be watching energy. I want to see if is it going to be a tactical play, to your point, or is it something that, because there's so many new ways to play energy, not just your classic oil, which is the center of today's story, but even associated with all the conversations we've been having over AI and energy demand and MLPs and all of the things we talk about in terms of different access to energy. So I would love to see if as a theme and as a sector, there's some interesting new threads that come just from this catalyst, if you will. I think fixed income is going to be interesting. I'm curious to see what happens there. And if folks keep turning to active management in fixed income, if benchmarks are going to shine, if it's going to be just a money market story, or if there'll be some really interesting dynamics there. So I think fixed income is really interesting as well this year.
I like those. I agree. I think fixed income, which is typically a very boring category, is going to be interesting to watch. The story I'm watching there specifically goes back to what I was alluding to before. Just if I look at longer duration bond ETFs, something like TLT, that's been under pressure for a while. And with rates ticking up, I'm really interested to see if there's some point at which investors will jump back in. I not investment advice. I just continue to not really like the overall risk reward there. If you look at the rates that longer term bonds are paying, and I think there are still clearly a lot of investor concerns regarding the government deficit. Certainly the spending on this war in Iran, that's not going to help that, at least optically. There are clearly still concerns around inflation. And so I think you're right in that fixed income is going to be an interesting category to watch, but specifically on the long end with those ETFs, I think will be a story. The other one, I guess, is the obvious one, which we haven't talked about, and that's whether ETF flows can break 2 trillion this year and set a new record. I did see a stat from State Street's Matt Bartolini that despite the fact we had a record quarter in flows in the first quarter, as we talked about, only 50% of all ETFs had inflows in March, which compares to 70% of ETFs over the past 6 months. So it's that deceleration we were talking about. And if we continue to see that and some apprehension from investors, clearly it's going to be really difficult to break 2 trillion. And maybe we're looking at something more along the lines of what we saw last year, 1.5 trillion, 1.6 trillion, something like that. But I think that will be a fun story to watch, as it always is. I don't know if you have any quick comments on that.
Yeah, no. I was just going to say, if we look at seasonal trends, we tend to see Q2 slow down. Q3 is the summer lull. Nothing happens. And then Q4 tends to be blockbuster. So if we average it all out, we could be on track, I think, for a 1.7 trillion or so. 2 trillion is going to call for a spectacular Q4, assuming seasonal trends hold. So it could happen. But that's, again, years where there's a war, it's so hard to anticipate what's going to happen. But, John Mayer just posted yesterday what he calls his GOAT chart. And he talks about what 40% of trading today is in ETFs. And it just keeps going up. So trading, investing, long-term ETFs are just the vehicle folks choose for when markets are challenging. So it could be that 2 trillion is the mark. We'll see.
Well, I think a perfect spot for us to end the conversation, Cinthia. Fun chat as always. Thank you for joining me.
Thanks for having me, Nate.
That was Cinthia Murphy, investment strategist at VettaFi.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
I'm now joined by Troy Cates, co-founder and managing partner of NEOS Investments, who currently offers 19 ETFs, over $22 billion in assets. And as I mentioned at the top, this is one of the fastest growing ETF issuers out there. About $18 billion has flowed into their ETFs just over the past year. $18 billion over the past year. They have been a remarkable ETF success story, especially for an issuer that's only been around for less than 4 years. But NEOS focuses on what they call next evolution option strategies. That's actually what NEOS stands for. And there's no question these options-based ETFs are resonating with investors. And so, Troy, welcome back to the podcast. It's been a while.
It has been a while. Thanks for having me back. I think the last time we were on was right after we launched our first 3 ETFs in late 22, I believe.
Well, I think you're right. And, it's interesting. I was thinking about that conversation and then where we're at today. And sometimes when I look at ETF issuer success stories, I'll dig into the individual ETF flows. And as it turns out, they're one-hit wonders. like you'll see one ETF driving everything, which is perfectly fine. That can still be very successful. But I was looking at flows into your products. And while you certainly have some big hits, you're seeing very healthy interest really across nearly every NEOS ETF. It's truly remarkable. So, how has the ride been for you over the last 4 years or so?
No, thank you. Listen, the ride's been very exciting, and yes, we are a newer issuer in the sense that we've launched our first three ETFs in August of 22. But my co-founding partner Garrett Palel and I have been in this business, focused on the option income space for well over a decade. We launched a lot of the early option-based products. We eventually sold that business and continued to grow it with that acquire. But for Garrett and I, when we decided to launch NEOS, we really wanted to take what we were doing kind of on the private side of the market, all these option strategies that we were doing for private institutions, large family offices, and bring them to everybody. Because as the ETF market grew, and really what you could do in an ETF with an option grew, and was what was more accepted, we realized we could bring a lot of these strategies out. So we launched, as I said, in August of 22 with three ETFs. And as you said, now we have 19 ETFs. And it's been an incredible ride. You know, the firm, when we were first sitting here in the office a number of years ago, when we first talked, there was maybe 5 of us here. Now there's over 35 of us here. So it's been nice to see the business grow. Obviously, the AUM's been great. And like you said, it's really, yes, we have 2 larger ETFs, QQQI and SPYI, but the growth has been across the board. Some of our newest ETFs are some of the fastest growing ETFs we have. So it's been really exciting to watch it grow and to continue to bring out some really good and nice innovative products.
And when I think about the growth of the options based ETF category overall, as I mentioned, this has been a really good spot to be. You clearly saw that as an opportunity going back several years. What was it that you saw that you thought, you know what, this would be a good space to bring an ETF issuer, be positioned around these options based strategies? What exactly were you seeing? Because clearly you were right.
I think what Garrett and I were seeing was that a lot of these private institutions like to use option strategies to either mitigate their risk, to add income, to lower their overall portfolio volatility. And we just saw a space in the ETF market saying, if we could bring this out to everybody, anybody who could buy one share of our ETF could have access to what we look at as the institutional quality product, could be a part of that. And I think the search for income is really important. I think, people look at most income people look at their fixed income portfolios. And I feel like that hasn't been cutting it as much as it should be for most people. And we saw that in 22 when everything sold off. And so I think people were looking for alternatives, different ways to source income, and sourcing income from the volatility of an options market around an underlying reference like the S&P or NASDAQ or Russell made a lot of sense to us.
Okay, so let's look at some of those specific ETFs to give people a better idea of exactly what's going on underneath the hood here. And as you were alluding to, your 2 most popular right now are the NEOS NASDAQ 100 High Income ETF, ticker QQQI, and then the NEOS S&P 500 High Income ETF, ticker SPYI. Do you want to briefly take us through the strategy behind these two, which are both well over $8 billion in assets?
Yeah. So if you think about, we use QQQI for the example. This is a product where we're long all 100 plus names of the NASDAQ 100. So still getting that exposure to the NASDAQ 100 and all those names in there. But what we're doing is we add an active options component on top of it. And everything we do here is rules-based and systematic. So when we say active, it falls within the active ETF wrapper, but there's no discretion taken by me or Garrett as the portfolio managers or the trading team. Everything is rules-based and systematic. And what we're looking at is volatility, the level, rate of change of volatility, and a few other factors to decide on a monthly basis when we're selling those calls to bring in premium to distribute out. How much of the notional are we covering? How far out of the money are the calls written? And I think that's really important because generation 1, a lot of the products we brought out years ago, were all at the money buy rights on 100% of the notional. And that's what you could do in an ETF back then. It was an index tracking product. Now you could be a little more systematic, rules-based, and decide, okay, we're going to sell calls out of the money. We're going to not cover 100% of the notional. For example, when we rolled at the end of the month in QQQI, we covered 50% of the notional. So that leaves about half the portfolios not covered by short calls. So if we do wind up having a rally this month while we have this short call position on, and it goes through the short call strikes, we could still potentially participate past that past those strikes because not the entire portfolio is covered by the short calls. So it's things like that that our rules look at, because we want to not only bring in enough premium to distribute out, but we also want to capture as much of the total return of the NASDAQ 100, especially in the years when it's moving higher, to capture that upside.
Well, and talk just a little bit more about that. Like at a high level, how should investors think about the experience of investing in QQQI or SPYI versus, say, the triple Qs or SPY? What's the difference going to be?
The difference, you're going to see one, a monthly distribution. So you're going to get where, the NASDAQ 100, the S&P 500, they have very small, tiny distributions, which is all qualified dividend income coming off of the underlying names. We still distribute that out, but we're also enhancing and adding to that distribution. We're paying that out monthly because we're sourcing premium from the volatility of the options market. So we're selling those calls, we're bringing in premium, and we're distributing that out along with any qualified dividend income we're seeing. So one, you're going to get that monthly distribution. And two, you're going to see that in the up markets, in the more bullish markets, you're going to capture a good portion of the upside of the underlying reference while still having a lower volatility product. In the flat to down markets, you might see yourself outperforming the underlying reference because you might be bringing in premium that gets distributed out, but that premium helps you with your total return versus, say, the straight beta product of the NASDAQ 100 or the S&P 500. So again, in the up markets, you're not going to capture all of the upside, but you're going to capture a good portion of it. And that's kind of the goal of this product, to capture a good portion of the upside and still have that, tax efficient monthly income.
Okay, so those are your two most popular ETFs right now. I was looking at your lineup this morning, and there are several other ETFs I want to ask you about. So we can just go through these. These all caught my attention for one reason or another. And this first one, it won't surprise anybody who listens to this podcast, but the ETF is the NEOS Bitcoin High Income ETF, ticker BTCI. This has close to $1 billion in assets. I'm showing a nearly 30% distribution rate on this product. Talk about BTCI, which I'll tell you, this is a category that is seeing some additional competition recently.
Sure. Now, this is a product we launched almost 2 years ago now. And it's been exciting for us because we talk to a lot of advisors all the time. And a lot of them didn't know when or how to get into Bitcoin. They had more and more clients saying, you need to have Bitcoin exposure. You need to have Bitcoin exposure. So we wanted to bring out a product that fell within our suite that could provide income off the volatility around Bitcoin. And as you can imagine, volatility in Bitcoin is greater than the S&P and NASDAQ. So you're going to bring in a lot more premium while still writing further out of the money and on less notional. So if on an average month, we're writing on half of the notional, and if the S&P were writing 2 to 4% out of the money, in Bitcoin, we could be writing 10 to 20% out of the money. So giving it a lot of room to participate when Bitcoin moves higher. So this has been a product that continues to bring in flows, even as we've seen Bitcoin, the price of Bitcoin basically get cut in half over the past 6 months. We've continued to see nice inflows because I think people are looking to source that income off the volatility of Bitcoin. And then when it does, or if it does actually move higher, we should capture a good portion of that upside because of how far out of the money we write those calls and on how little of the notional we do on a monthly basis. So it's important to understand that dynamic and how our rules-based strategy works. But yes, we're talking to advisors all the time that, had clients that looked at Bitcoin at 25,000, at 50,000, at 75, and didn't want to touch it. And then it went to 100,000. They had to be involved. And of course, it's come back in from there. And they're still adding to those positions. So yes, there's definitely a lot of competition coming, it seems like, in the marketplace. But for us, we've been here for a little while in this space, and we think we still have a strong offering with BTCI.
All right, another ETF that stood out to me, if we go from so-called digital gold and Bitcoin to physical gold, would be the NEOS Gold High Income ETF, ticker IAUI, which I saw this just won ETF.com's Best New Options Income ETF for their 2026 awards. But do you want to touch on that one?
Yeah, no, that one's been strong. We launched that last summer, so coming up on the 1-year track record soon. Really excited about the award we got from ETF.com. I think, it's exciting for the entire team because everybody's, from marketing to distribution to the trading team, everybody's working hard to make sure these products are doing what they need to do and telling the right story. So it's nice to get that recognition. But for this product, again, we're talking to advisors all the time. A lot of them have these static, 2, 3, 4% allocations to gold that they just have in their models. And for the longest time, they've never had a gold position that could really pay any kind of income unless they're selling it gradually over time. And for us, it made sense to try to figure out, how do we bring out a product in an ETF wrapper that could source some of that premium off the volatility of gold and pay that out in a monthly distribution. And IAUI really was kind of a follow on of what we're doing in the alternative space with Bitcoin, Ethereum, real estate, and so forth, and really just having another alternative. The way we look at ourselves is really as a solutions provider. While we focus on the option income space, we really want to have things offering in the equity products, the alternatives, fixed income. So it's really important for us to continue to kind of slice up that asset allocation, and gold made a lot of sense for us.
And you make a good point there, just with gold, in that it is a non-income producing asset, just like Bitcoin. And so you've taken both of those assets and changed that. That's been a criticism of both of those. So if you want income out of those categories, you can now get it. The last ETF I'll ask you about, which this is also around $1 billion in assets, the NEOS Enhanced Income 1 to 3 month T-bill ETF, ticker CSHI. I'm curious, what's the allure of this strategy?
So CSHI was actually, of the 3 ETFs we launched in August of 22, was the first one to gather assets. So it was really exciting for us, think about what people are doing in 2022. They were starting to shovel money towards cash and ultra short duration products as the Fed was raising rates. This was a product, when we designed it, when Garrett and I sat down, we were really trying to figure out how to have a very low vol option portfolio on top of a 1 to 3 month T-bill portfolio that could, potentially, if you kept the vol low enough in the option portfolio, produce 1 to maybe 1.5% over whatever your T-bill portfolio was doing. So for this product, if you're getting an extra 1 to 1.5%, yes, when rates were up at 5+%, it wasn't as enticing. But as rates come in, we're seeing more and more interest because people are reaching for more yield. Now, this is different than some of the products we just talked about where we're selling calls. In CSHI, we're actually rolling on a weekly basis a short S&P 500 index put spread strategy. It's deep out of the money. We want to roll it weekly to move away from spot, but we also want to be able to take advantage, if we can, of volatility. And we've seen a lot of volatility over the past year. And when the volatility spikes and the equity markets are selling off, that gives the portfolio an advantage of being able to roll and capture some of that extra premium on a weekly basis. So for us, it's really thinking about having, a 1 to 3 month T-bill portfolio. And you look at some of the competitor products out there that are, 10, 20, 50 times the size of this ETF. But we're just adding that option strategy on top of it to bring in a little bit more enhanced premium. That's why our fixed income products are all enhanced. It's what can you give on top of whatever the underlying fixed income portfolio is doing.
And how should investors and advisors think about any additional risk associated with this product versus just straight T-bill ETFs? I was actually talking in the previous segment that there's clearly been a lot of interest, especially in the first quarter, around some of these short-term treasury products. It's the old T-bill and chill. I think in the current market environment, this is where investors are looking. So if you have somebody looking at, say, your product here and some of those other products on the market, what are some of those considerations?
Yeah, I think the added risk, when you're selling a portfolio of S&P 500 index put spreads. Now, we're doing put spreads, so we're not just selling naked puts. But what is your risk? You're bringing in a long equity bias. So it's, not correlated to what the fixed income is doing. So if the equity markets sell off quickly in a 1 week period, let's just say last April, tariff announcement, we had this massive sell-off in the equity market. At the same time, volatility spiked to levels we hadn't seen on a closing basis since COVID. So we had this big equity sell-off. Your risk is what that put spread is. And that put spread on an average week is anywhere from 3.5% to 4%. We didn't even get through and to, kind of walk you through it. The put spreads are laddered out. So it's not just one put spread, it's 4 put spreads for this product. We barely got through the first put spread. So the portfolio was down small, but because volatility moved to so much higher, we were able to bring in so much more premium on that roll. And yes, the market did bounce a week later, but if we had kind of just stayed flat with an elevated vol, we could have brought all that premium in and, brought back the losses that we had for that 1 week. So I think at our worst case scenario, it was down just over 1.5% during last April. And quickly within 2 weeks, it was actually higher. So giving you that boost from the added volatility, of the market and that added premium that you can bring in. You could bring back that, those losses quickly with the way we roll the product.
All right. So I told everybody at the top that we're going to do a nice little tour through the NEOS ETF lineup. I think we're doing a pretty good job here. We've touched on many of the most popular ETFs. Before we talk due diligence in this category, which I definitely want to get your thoughts on, is there another ETF or two that you would like to highlight? I know the NEOS MLP and Energy Infrastructure High Income ETF, ticker MLPI. That's seen some nice attention recently after launching in December. I saw these three boosted ETFs that you launched a couple of months ago, which, as I understand it, these introduce a little bit of leverage into the equation. So any comments on those or any other ETF you'd like to point to?
Sure. No, MLPI has been a really strong one. We launched that in the middle of December, right before the holidays. And I think seeing obviously with what's going on in the world, people are focused more on that energy infrastructure kind of sector. But we've seen a lot of inflows into MLPI. It's probably been our strongest launch in the entire suite that we've ever seen. And it continues to grow. Performance has been great, obviously, because of the geopolitical environment right now. But for us, we really saw a need for that. Again, talking to advisors, talking to investors that were looking for how could they bring in more income and have a larger distribution that they could have for their shareholders from the MLP and energy infrastructure space. So this is one we were really excited to get out. And then, of course, our boosted, that's our newest suite of ETFs. We launched 3 ETFs that are all levered versions of our ETF. So SPYI has a boosted version, QQQI has a boosted version, and BTCI has a boosted version. And we're doing this a little differently. We're thinking about it as long-term leverage. We're not doing a daily swap to make sure you have a 1.5 of whatever that day did. We're doing it to get you a 1.5. That is our goal of whatever SPYI will do over the year. And, of course, there's risk to that on the downside. You're taking added long leverage. So if the market's coming in, you're going to have more exposure to the downside. So it's just really an education for people to understand that the leverage works both ways. And I want people to understand that. And that's something we've been going out on a lot. But we've seen a lot of nice flows into that, especially as we've seen the volatility kick up a little, really trying to grind through what's going to happen with this market, what's going to happen with this, current war situation going on and where the market might go after. So we've seen some really nice interest in that.
Yeah. And by the way, going back to MLPI, I just pulled it up, 475 million in assets, again, just launched in December. So I think shows the interest around there, very steady demand. Okay. With our remaining time, I do want to ask you about 2 topics that I always like to cover. I mentioned ETF due diligence is one of them. And then I also want to ask you a little bit about ETF education. And on due diligence, Troy, I think everybody knows the story around the rise of options-based ETFs. This is an enormous growth category. There's a lot of competition. We were talking about this earlier. So what would be a few key items that investors and advisors should consider as they look at various options-based strategies? And I know there's a lot here, but if you had to pick maybe 2 or 3 of the most important considerations, what would those be?
Yeah, there is a lot because I think you've seen a lot of people coming into the market space that have not traditionally focused on this part of this sector of the market. For us, this is what we do. At the heart of it, we're option managers. So I think really, as people start to look at the space and educate themselves, I think focusing not so much on whatever distribution yield is. Don't source by the distribution yield. Really, as you're comparing maybe to making a NASDAQ 100 products or 10 NASDAQ 100 products, look at the total return, look at the overall volatility, understand how potentially what the taxes could be for those different products, because not all option strategies are created equal. So where we use index options, where we try to convert any ordinary income into either a longer term cap gain or potentially a return of capital. And that's something to talk about, of course, too, and to understand how tax efficient, you're going to get this distribution at the end of the year, and your clients are going to get a 1099. How much of the distribution do they get to keep, or how much do they get to defer through a return of capital structure? So it's important to kind of go through all of those items and understand what you're getting with each different strategy.
Yeah, I think taxation is a critical one. I think there's a lot of confusion around the taxation of various options-based strategies, and you just did a good job of hitting on some of the high notes there. I think from a due diligence perspective, that's clearly one of the most important. Let me ask you this. I'll just tie this into the education front. How has NEOS approached educating investors and advisors on options-based ETFs and things like taxation? Because the space is more complex. I think there are obviously a lot of important due diligence considerations. So, what has been your approach to help get the word out to investors and advisors?
Yeah, we try to do the best we can with getting the word out. We can't talk to individual investors, but we can talk to advisors. We also we put our own podcast out where we try to talk about some of this educational stuff. There's always a lot of confusion around tax time. I got a 1099, but there's a 19A1 notice. What does that mean? And we try to educate people that a 19A1 notice is not for your tax reporting. It's an estimate that is built by the fund accountant that has to be put on our website per SEC guidelines. So it's things like that we try to educate on through, whether it's our podcast, webinars we do for advisors, or forums like this where we could talk about what it means to invest in an option-based ETF. So Garrett and I try to go out as much as we can and talk about our products and what they mean from a tax efficient standpoint, and what the education around that looks like. So it's important for us to try to get the word out and try to educate as much as we can, because there are a lot of products coming out. I think last time we looked at the end of last month, there's over 800 ETFs in the market now with options in them in some way or shape or form. So there's a lot out there for people to kind of sift through and understand what they're doing or investing in.
Well, Troy, congratulations on all the success. It's always great to see stories like yours. It's been such a fun ride to watch over the past 4 years, and I certainly wish you continued success moving forward. Thank you for joining me.
Thank you for having me.
That was Troy Cates, co-founder and managing partner of NEOS Investments. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I'll be joined by Chris Davis, Chairman and Portfolio Manager at Davis Advisors. So we're going to talk current market environment and actively managed ETFs. And then I'll also be joined by one of my favorite ETF gurus, Todd Sohn, Chief ETF Strategist at Strategist. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.